Hello, I'm MaryAnn. U.S. oil inventories came in almost 5 times higher than expected this week, and the price of oil dove once again. Which way do oil prices go from here, and what does this mean for investors and consumers of oil here in Canada, where we are the 10th largest consumer of oil in the world? Michael Loewen, commodity strategist at TD Securities. So we've seen U.S. oil inventories climbing, but yet oil rig counts are falling. Is this causing all the volatility we're seeing in the oil patch right now?
Partially, yes. A lot of people fail to realize that rig counts and supply are not directly related. In fact, there is a pretty large supply response lag.
Really?
We call it 2 to 3 months, maybe longer, between actual rig counts to supply. And the fact that rig count efficiency, so the ability of rig counts to actually produce oil or find oil and bring it out of the ground, has been improving drastically over the years.
With technology.
Exactly. So the declining rig counts, which have been falling since mid-December for sure, and have obviously fallen much more steeply of late, does show long-term that supply will probably taper off later into 2015 or into 2016. However, right now, supply is still moving higher.
So that's why we're getting these oil inventories climbing, especially in the U.S.?
Exactly. Actually, today, with the DOE report, domestic production reached 9.2 million barrels per day, which is a new record since the early 70s in the U.S.
Wow, that's pretty big then.
And there's nothing stopping supplies from at this point. Yeah.
So does it seem like I've seen analysts say that Saudi Arabia is no longer that swing producer and that it's now the U.S. Would you agree with that?
Actually, I would. Saudi Arabia has been growing its foreign reserves drastically over the last 10 years, and they have been looking for basically an opportunity like this for when their market share starts to fall. They can dip into those foreign reserves and prop up the industry over the long term. The U.S. is now the swing producer because they have a much higher cost to produce oil, whereas Saudi Arabia produces in the the high single digits, or $8 per barrel approximately. So why would they want to be the swing producer when they could gather market share when prices fall, when North American obviously fit that bill?
Nicely. Where do we go from here on oil prices then? Which way do you see it going?
Well, if today's oil prices are any indication, we're going to go quite a bit lower. We could see a 30 print, so 39,
wow,
maybe 35 by mid-Q2. A lot of this has to do with storage availability in the U.S. As of most recent storage data, we're at about 82% full in the U.S., and that's up about 12% in the last 6 weeks. Over the next, call it 2.5 months, we could see storage fill much further, much faster as refineries come offline, and hence storage supplies start to grow very, very quickly.
So kind of longer term, you're thinking in that 30 range, or do you see it moving, say, a year or two out?
So back to the rig count discussion, that lag in the U.S. is obviously going to be a factor. So as rig counts continue to fall, supply will eventually start to plateau, then fall in the back end of 2015. Once that happens, that'll tighten up supply-demand balances locally or domestically here in North America, and that will be supportive of pricing. Later on into 2016 or so, we should see prices plateau around the marginal cost per barrel, $65 to $75 per barrel, largely due to the amount of wells that have not been completed. They've been previously drilled but not completed, bringing on additional supply when prices actually recover.
So there's really a lot going on in the oil patch. I know in Canada, everyone likes to go to the gas pump and get a better price, but it's not so good for everybody in Canada. What's been going on, especially out west?
Well, the interesting thing about out west is they import quite a bit of oil from the U.S. And a lot of people fail to understand that the amount of volumes that we import from the U.S. is largely this light oil or condensate that we get from, say, the Bakken region that we use to mix with our heavy crude oil up north. This is an added cost. So if the Canadian dollar has fallen to, say, $1.25 as of late, that is obviously an additional cost to the Canadian producers. On the flip side of that, the overall price per barrel is lower, which brings down the cost of, say, the gasoline in our tanks, which is good for the consumer, as well as the devaluing Canadian dollar is good for the manufacturing sector in Canada. Obviously, the cost of the oil patch is a little bit higher.
All right. And what does this mean, do you think, for investors then? You were saying a lower oil price than a higher oil price, so we kind of know where the lay of the land is, but with equity investors, still volatility ahead, it seems like.
There's going to be tremendous volatility over the next little while. I think that there's going to be actually a very good case to start investing in energy stocks later into Q2. A lot of this has to do with prices bottoming out and then recovering later on. However, I would be hesitant to jump in right now because of prices falling over the next few months. As investors start to look at valuing these companies on 2016 and 2017 price per barrel, or they feed that into their net asset value and the value of their commodities, of the equities, there will be a compelling value proposition for these equity investments later in the year. However, at this point, there's far too much volatility, and prices are expected to plummet a little bit further in the next couple months.
Thank you very much, Michael. I've been joined by Michael Loewen, commodity strategist for TD Securities. Thanks for watching.